The psychology and biology of money, beliefs, routines, and rituals. Have you heard the story about Ronald Read, the janitor that had $8 million in savings when he died in 2014? Yes, you heard that right. Janitor. $8 million. And he didn't win the lottery or inherit the money either. Read saved what little he could and invested it in blue-chip stocks. Then he waited for decades as tiny savings compounded into more than $8 million. The moral is that your behavior with money is oftentimes more important than how intelligent you are. Even if you don't have a diploma from Harvard or work on Wall Street, you can become rich by just behaving in a sound way. As Morgan Housel puts it, financial success is not hard science, it's a soft skill, where how you behave is more important than what you know. 3 top takeaways on Ronald Read's story. Takeaway number 1, pay the price. Investing comes with a price. There are some recurring takeaways for high returns, one of them being a somewhat concentrated portfolio. The concentrated portfolio brings with it a characteristic to your performance. It will be highly volatile. This is the price, the fee for having high returns in the stock market over the long term. If you don't have the stomach to stay the course when your net worth decreases by, say, 20% during a single week, as 2 of your major holdings report quarterly earnings below what analysts expected, don't aim to maximize your returns, because the higher the returns, the higher the losses. Let's say 10 years ago, you could visualize Netflix's bright future. You invested a large portion of your net worth in the stock. Well, then you would be quite a rich person today. However, could you afford paying the price for this journey? Netflix has, during this period, had many major downturns. Would you have sat still in that boat during 2011 when Netflix lost tons of customers, and the stock price fell 80% from its peak during the ensuing months? Your portfolio returns would look terrible. What would you tell your spouse and your kids? Could you stomach facing them knowing that you might just have endangered their future? Would you still think that being almost all in Netflix is a good idea? This is, of course, an extreme example. But even if you have something less extreme than an all-in Netflix approach to investing, you'll have to pay the price of volatility nonetheless. Let's say that you bought an S&P 500 index fund in 1980. You'd still have to face about 13 years combined when your investment portfolio was down 20% from its high, and about 8 months when it was down 50%. That's tough. Stock market investing is a great thing that enables wealth creation like few other options. But don't try to fool yourself. It doesn't come for free. All investors will experience volatility, and you have to look at it as the price you pay for a brighter future. Takeaway number 2, never enough. You can hand somebody a $2 million bonus, and they're fine until they find out that the person next to them got $2.1 million, and then they're sick for the next year. The urge to surpass your neighbors, peers, and friends can help energize your hard work and strive to really make it. But social comparison can also cause us to feel like we're never enough. Let's look at some statistics. To belong to the top 1% highest income earners in the US, you'd have to earn somewhere around $500,000 a year. That's what a highly specialized doctor, let's call him Bill, earns. And by almost any standard, Bill would be considered rich. He can afford to drive nice cars, go on long vacations to exotic countries, perhaps hire someone to do work which he thinks is tedious, etc. Bill has been feeling about himself and what he has achieved financially in his life. Well, that was until he bought a vacation home in the Hamptons and realized that he had Stan as his neighbor. Stan belongs to the top 1% of the 1%. He is a CEO of a quite large public company and earns a staggering $10 million per year. Now, you'd hope that at least Stan would be satisfied with his financial achievements. But nope. This guy was a childhood friend of Michael Jordan, and this all-time great basketball player is someone who belongs to the 1% of the 1% of the 1%. And well, compared to Michael's fortune of about $2 billion, Stan's yearly salary of $10 million suddenly seems like peanuts. Does it end here? Well, no, it doesn't. No, this list is endless. The type of envy which has emerged from comparisons of this kind has caused a lot of people to do foolish things throughout history. Some have leveraged their portfolios to the teeth in order to move up to a higher pyramid just to lose it all. Takeaway number 3, peekaboo. What does the Great Depression, World War II, the financial crises, and COVID-19 all have in common? They were all events which shaped our society. They had huge impacts on the financial markets, and they were pretty much impossible to foresee. Human nature fools us into believing that we should have been able to know it would happen all along. Imagine it is Black Monday 1987. How would you have reacted to the market losing almost 1/4 of its value in one day? Would you have been one of the individuals that shouted, "Sell, sell"? Or would you have been able to weather the storm? Perhaps putting in additional chips which you've kept on the sidelines. Here's an interesting fact. If you invested in the S&P 500 index 20 years ago, but you missed out on the 4 best performing stock market days, you'd have a 164% return instead of 291%. That's quite a big difference. The moral of this takeaway is that it's more useful to prepare yourself both mentally and financially for a change which you cannot foresee than hoping that you're able to react before everyone else.